opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Viral Shah from IIFL. Thank you, and over to you, Mr. Shah.
Thank you, Renju. Good morning, everyone. This is Viral Shah from IIFL Capital. Welcome to the 1Q FY27 earnings conference call of Finance Limited. On behalf of IIFL Capital, I would like to thank the management of Finance for giving us this opportunity to host the call. From the management today, we have Mr. Sanjay Sharma, Managing Director and Co-founder, and other senior members of the management team. We will have opening comments from the management team, post which we will open the floor for Q&A. With that, I would like to transfer the call to Sanjay for his opening remarks. Over to you.
Thank you, Viral, and good morning, everyone, and thank you for joining us today. On behalf of Finance Limited, I would like to extend a warm welcome to all the participants on this Q1 FY27 earnings call. Joining me today here are Mr. Neeraj Kaushik, the Deputy Chief Officer, Mr. Gaurav Seth, the Chief Financial Officer, Mr. Shobhan Satyaprakash, the Chief Strategy and Investor Relations Officer, along with our Investor Relation Advisor team from SGA. iFinance was founded on a commitment to provide formal credit to micro entrepreneurs across India. We have remained dedicated to this mission, and with 571 branches across 18 states and 3 union territories, and over 6.7 lakh active borrowers, we occupy a dominant position in this typical market segment. Lending to Indian micro enterprises remains a significantly under-penetrated area, offering a substantial long-term structural opportunity. Our differentiated approach, which combines proprietary underwriting models, physical branches, and with processes that leverage AI and machine learning, it positions us uniquely to capture this market responsibly. I hope all of you have had the opportunity to review our financial results, investor presentation, and press release, which are available on the stock exchange as well as on our website. We have also recently uploaded a short documentation on our vision and FAQs to help the market understand our unique business model and the unique market segment that we address the demand for. Let me then start this by giving a brief perspective of the operating market environment before we discuss our quarterly performance. The micro MSME segment to which our services are addressed is showing a steady recovery that is built on the momentum of the last year, when the rural demand and consumption was significantly good. This was also supported by the various government initiatives and increasing formalization of this segment. So we have continued to see a constructive demand environment for working capital from our core markets. We began the year FY27 on a good note on the back of robust trends in business metrics in the Q4 of last financial year. Yet I had shown caution as the effects of West Asia war and the weaker monsoon were imponderables. Now, Q1, which has typically always been a slower quarter, has shown, and as you will see, very good, robust results, and we have met our plans on almost all the relevant metrics. I think Q1 does not show any signs of any sort of impact of the market imponderables that I talked of. And even as we look forward, the fear of impact of West Asia war has got moderated. And even the status of monsoon is not as alarming. In fact, if you go to the IMD site, it states that the expectation they have, and I'm quoting from that site, is about 92% of the long-term average one. So, irrespective of what we may feel, the monsoons are below normal, but not substantially below that number. Also, quoting the same site, most of the effect of lower rainfall or deficit rainfall will be seen in only central India and southern peninsula, and they in fact quote that there is also likely to be above normal precipitation in the northwest India and in the northeast India. North, as you know, is all rain-fed. So I think the impact, in my view, would be not as acute. And this is the reason I feel more optimistic about the quarter two as we enter it. And hopefully, by the end of quarter two, we will be able to narrow down our guidance to more refined numbers that we see. But we continue to maintain our guidance as we had given during the year. Now, against this backdrop, I am pleased to now start off on the first quarter of FY27 outcomes. Historically, as I said, this quarter tends to be seasonally softer, with economic activity and credit demand moderating after the financial year end. Despite this seasonal pattern, we have delivered the strongest ever first quarter disbursement performance, demonstrating both the resilience of our customer base and the strength of demand across the entire target segment. During this quarter, we disbursed 1,219 crores, which represents a growth of 22% year-on-year. The momentum translated into assets under management of 7,324 crores, reflecting a growth of 28% year-on-year and 4% sequentially from 7,044 crores that we ended March 2026 at. Importantly, this growth has been achieved while maintaining a disciplined approach to underwriting and portfolio selection. Customer acquisition has remained another area of strength even in the quarter that has gone by. During this quarter, we added more than 44,000 new borrowers, which is a growth of 38% over the same period last year. As a result, our active borrower base crossed 6.7 lakh customers. This reflects the continued demand for formal credit among the micro enterprises and the effectiveness of our distribution network across Tier 2 and Tier 3 markets. At the same time, we also improved our productivity across the organization. The AUM per employee increased by 12% year-on-year. The investments in technology, analytics, and process efficiency have enabled us to grow with improving efficiencies. As of June 2026, we operated, as I mentioned, through 571 branches across 18 states. This year, our strategy remains focused on deepening our presence in existing markets rather than entering new geographies. And hence, we expect to add only around 40 to 50 branches during the year while continuing to drive higher productivity from our existing network. Let me now focus on the asset quality. I am particularly encouraged by the continued improvement we have seen across key portfolio quality metrics, and this marks the fourth consecutive quarter of improvement and reflects the benefits of action we have taken over the last several quarters. Gross NPA improved by 28 basis points to 4.49% compared to 4.77% in the previous quarter and 4.6% a year ago. This represents our strongest asset quality performance in a single quarter if we look at the last year. PAR X stood at a very reasonable 7.01%, while PAR 30 remains stable at 6.07%, demonstrating the resilience of our portfolio even as we continue to address the residual stress that came from earlier vintages. Collection performance remained healthy and consistent. Our non-OD collection efficiency stood at 99.2% during the quarter, while bucket 1 collections were at 54.5%. Importantly, our large states like Bihar, Uttar Pradesh, Rajasthan, etc., which account for a significant share of the portfolio, continue to deliver good collection efficiencies. And let me also put a marker there. These are the states which are not expected to be affected by the issues of monsoon this year. These trends are also reflected in our credit costs. The credit cost declined to 4.01% during the quarter, improving by 29 basis points sequentially and continuing the downward trajectory that we have witnessed over the last years. Our guidance on credit costs was, and at the beginning of the year, we had given a guidance of 3.5 to 4%, and this appears well within our grasp now. The improvement has been driven by a combination of factors, including tighter underwriting standards, stronger collection efforts, a growth of mortgage loans within the portfolio, and improving repayment behavior among our customers as business cash flows continue to strengthen. Taken together, these developments reinforce our belief that the improvements in portfolio quality that we are seeing are structural and sustainable. As the portfolio matures further and operating conditions remain supportive, we remain confident of continued normalization in credit costs through the FY27. Another important development during the quarter was the upgrade of our credit ratings by the India Ratings and Research. Our long-term rating was upgraded from IND A to A+ with a stable outlook, while our commercial paper ratings are upgraded from IND A1 to A1+. We believe that this upgrade clearly reflects the strength of our franchise, the robustness of our risk management framework, the use of technology and analytics-driven underwriting capability, and the consistency that we have shown in our execution. Importantly, the upgrade further strengthens our funding profile. It is expected to, on one hand, broaden our lender relationships and enhance funding flexibility, and on the other hand, it is also going to reduce our borrowing costs by approximately 20 to 25 basis points on the incremental borrowings over the course of the year. Moving to our core financial performance, we believe that we delivered a strong set of numbers during the quarter. Gross total income grew 22% year-on-year to 490 crores, while the net total income increased 38% year-on-year to rupees 322 crores. Despite the increasing share of mortgage loans in our portfolio, our NIM actually improved by 20 basis points sequentially to 15.9%, powered primarily by the falling interest cost and the falling overall borrowing rates. Pre-provision operating profit stood at 179 crores for the quarter, and supported by improving asset quality and moderating credit costs, profits after tax increased 144% year-on-year to 75 crores for the quarter. This extends the strong profitability momentum that we established during the second half of FY26. Our balance sheet continues to remain exceptionally strong. As of June 2026, our capital adequacy ratio stood at 41.3%, providing substantial headroom to support future growth without the need of additional capital in the foreseeable future. Looking ahead, we remain optimistic about the opportunities in front of us. Business momentum has remained encouraging, and we expect activity levels to strengthen further as we move across the year. India's micro-enterprise segment continues to offer us a significant long-term opportunity, and we believe that iFinance is uniquely positioned to capture this opportunity through its differentiated business model, disciplined execution, strong risk culture, and a deep customer relationship. Our priorities for the year remain clear. We will continue to pursue responsible growth while maintaining underwriting discipline. We are targeting a AUM growth, as we have said in the guidance, between 25 to 30% for this year. We will drive further normalization in credit costs towards our guided range of 3.5 to 4%, and we intend to gradually increase the share of mortgage loan in our portfolio this year. Alongside this, we will continue investing in technology, in analytics. Even in the AI area, we have already had machine learning models and AI-related models deployed over the last few years, and we continue to focus and strengthen those. And we will also strengthen our distribution network to enhance customer acquisition. We are already very good at, but we can do better, and improve productivity and strengthen long-term profitability. With that, I would like to conclude my opening remarks and open the floor for questions. Thank you very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Sajal Raj, Zenflow Finance Private Limited. Please go ahead.
Good morning, sir. Am I audible?
Yes, you are. Please go ahead.
Sir, I have three questions. So first one, despite the improving asset quality and declining credit costs, the guided credit cost of 3.5% to 4% remains significantly higher than the peers. Could you explain the key factors behind maintaining such a conservative guidance despite tighter underwriting standards?
Hi, Sajal. Thank you for that question. So I think, as Sanjay mentioned, we are uniquely positioned in the micro enterprise lending space with the product, which is the core product that we are talking of, which is hypothecation loan, typically with a tenor of about 24 months and 1.5 lakh average ticket size. Now, when we compare this product to many of the peers who predominantly operate in the micro lab, the product is quite different from that standpoint. Having said that, the terminal losses that we observe across both the products, be it a micro lab product or a hypothecation product, remain very much in the same range of about 5.5% to about 6%. But when you look at from a yearly credit loss or cost standpoint, this usually translates between 3.5% or so. Because of that, we believe that this business model typically should give a credit cost of roughly around 3.5%. In a good year, it can come down to as low as 3%, but should be in the range of between 3.5% to 4%. So that is the guidance that we went forward with at the beginning of the year. Quarter one has definitely been encouraging, where we are already at the top of that band that we are talking of. And as we move into the subsequent quarters, we do feel that this number should improve further. And by end of H1, I think we can give a more tighter guidance and talk of maybe more narrower ranges.
Thank you, sir. My second question will be on, could you share the portfolio yield at the end of the Q1 FY27 for each of your four business verticals? This will help us better understand the yield mix and profitability across the portfolio.
So the portfolio yield at the end of the quarter was 22.4%. This is taking into account the mix of HL as well as the hypothecation loan as well as the lab product. So that's the portfolio yield that we have.
If we talk of the product-wise portfolio ROI levels, typically mortgage has a portfolio ROI of about 23.5%. Hypothecation loan that we do ranges between 27.5 to about 28 odd percentage. As the mix changes, the blended level value changes accordingly. There are different reversal levels of both the products because of delinquency levels of each of the products, but the portfolio ROI is about 23.5% to about 27.5 to 28% for the hypothecation loan.
Thank you so much, sir. And sir, in this quarter, the fee and other income has decreased. Could you give us some kind of color on it?
Yeah, so the fee and other income has decreased primarily on two accounts. One is since we had injected capital in February, so there was the IPO, we did not feel the need to borrow more from the DA, and therefore we did not undertake any DA, the direct assignment deal during the quarter. Last quarter, DA had contributed to around 20 crores. The second is on account of the foreign exchange movements. Till last quarter, all the foreign exchange volatility was being taken into the P&L. And therefore, last quarter, we had a 12 crore profit coming in from there. Nominal. This was a notional profit because it's over a period of time it gets sort of settled off. From this quarter onwards, we moved the foreign exchange movements into OCI, and therefore we will not going forward see any fresh movements on this line. So both of these taken together account for nearly 35 crores of 32 to 33 crores of fee income. The next one is Q4 has, as Sanjay had mentioned at the beginning, has a huger dispersal as compared to Q1, and the drop in dispersal therefore will lead to some drop in cross-sell as well as other fee-related incomes.
Thank you so much, sir, and all the best for the future.
Thank you.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Sameer Bhise with Diamond Asia. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a very good quarter, sir. Just wanted to understand how should we kind of think on incremental customer addition, because obviously you would have tightened some of your underwriting standards, and still we are seeing very good customer addition growth. So if you could just see how things shape up on this will be great.
Sure. Thanks for that, Sameer. I think we have seen the credit policy getting tighter. Earlier, we used to allow roughly 55% of the cases logged in used to be approved and disbursed. That 55% has shrunk down to 45%, and we have continued to keep that policy tight. Despite that tightening of policy, we continue to see very good customer acquisition. As I mentioned, 44,000 customers were acquired during the last quarter. So I think it is despite that. Why does that happen? Primarily because the market itself is very large and gives us tremendous opportunity. Second is our product is extremely tightly integrated to what the market segment desires. They want a typical working capital loan of 1 to 2 lakh rupees. So this is a real market need, and that is the second reason why we have seen enough demand. And as I mentioned, that is a highly underpenetrated segment. So we see a lot of demand. It is spread across the entire country, so it's not coming from one particular part of the country. We are there in 18 states and 3 union territories. So I think that is one unique strength that we carry, that we can generate 44,000 loans in a single quarter despite tightening of credit.
Fair. This is useful, sir. Secondly, if one were to look at the guidance, obviously we are running better than the guidance on the top line and margins. I presume this includes some share of mix change with respect to mortgages, like towards mortgages, and also leverage building up. Is that the right way to look at it?
Yes, I think, while we are today already at 22% of our portfolio is in mortgages, we expect it to only grow marginally through the year. So our strategy has always been that hypothecation loans serve the customer better, and it also produces the required ROA for the business. So one is that while the mix will certainly move a little more towards mortgages, that movement is marginal. This will lead to a lowering of the overall blended portfolio yield. But as we saw in first quarter, that reduction is more than made up by the reduction in the finance cost, even as the percentage of borrowing cost. So this actually compensates for that, and in fact that's the reason in quarter one we've seen an increase in our NIM. This trend is expected to continue through the year, and we therefore are guiding that NIM will remain flat. It will not come down.
Okay. So this is helpful. Finally, on credit cost, I think very proactive step to slowly kind of make additional provisions. How should one see on long-term loss rates in this business? And if mortgage share inches up, will there be a reduction in long-term credit costs? May not be, say, a 12-month kind of a window, but over a 2 to 3 year period.
Sameer, rightly
asked on that particular question, with the mortgage share increasing, and we have talked about it in the past calls also, that we intend to increase the mortgage share eventually to about 30 or 35 odd percentage. As the mortgage share increases to the range of about 30%, definitely at a blended level, credit cost should come down. So with the current levels that we are, and obviously the opening numbers that we entered this financial year, we guided for a 3.5% to 4%. But with mortgage increasing eventually, and not in this financial year, but eventually increasing to about 30%, we can safely assume about a 50 bps lower levels on the credit cost. So the range that we should be targeting once mortgage hits about 30% would be in the range of about 3% to maybe a 3.25 or 3.5% at max.
Great. Thank you. Thank you and all the best.
Thank you.
Thank you. Next question comes from the line of Shalin Kapadia with IIFL Capital. Please go ahead.
Hi, good morning everyone, and thanks for the opportunity. So first question I have is on margins. So for 1Q, I think it's at 15.9%, while the guidance is 14.25 to 14.75. Understand that this is also from the IPO proceeds. But with this 1Q number, do we expect some upside even from your upper end of guidance in terms of NIMs? Also, if you can break that up in terms of how you expect yields and cost of funds movement in FY27 for better clarity, that would be helpful.
Yeah, so in terms of the cost of borrowing, when I compare for the quarter and quarter, the cost of borrowing has been dropping. So the weighted cost of borrowing last quarter was 1087. That has already dropped to 1078. Our incremental borrowing has been coming at nearly 60 bits lower, and therefore my cost of the incremental borrowing that I'm doing today is at around 1020. This we expect with the credit upgrading. We expect to drop this further by around 10 to 15 bips. That's the first one on the cost of borrowing. In terms of the interest will continue. The interest in terms of the product mix, it continues to be. We reported the number at 22.4. Now this will continue to be in the same range. There will be a slight drop as the mortgage business increases, as the LAP business increases. However, from a NIM perspective, the guidance that we had given, we expect to stay on target.
Yeah.
Thank you. So second one is on asset quality. So we have some management overlay I think we have made in this quarter. Can you just quantify how much is the normalized credit cost and how much was from management overlay this quarter? And also, what is the total quantum of overlay that sits on the balance sheet?
Yeah, so the overall overlay that sits on the balance sheet is 11 crores. And this is lying in stage 2 and stage 3. The second question was in terms of the credit cost. The credit cost is at 4.01. This is so if you could just help. Yeah.
So on the credit cost front, we reported a 4.01% credit cost. Having said that, there was a management overlay created of roughly around 6 crores in this credit cost for this quarter. So beyond that should be removed from a actual credit cost calculation standpoint.
See, in terms of approach, we will continue to absorb some of the profits into these overlays because this is a good year, and we believe that in good years we should create that overlay. So I think that approach continues, and I think last quarter was a robust quarter on profits, and we have taken out 6 crores out of that to put into the overlay.
Got it. And lastly, more sort of a medium-term question. So you have mentioned in your vision statement that within 5 years you aim to reach AUM of 24,000 crore, translates roughly to 27.
Sorry for interrupting. There's an echo coming from the management side. Yep. Please go ahead.
Am I audible now?
Yes, please go ahead.
Okay. So yeah, so one medium-term question. You have mentioned in your vision statement that within 5 years you aim to reach AUM of 24,000 crore, which translates to roughly 27-28% CAGR within 5 years. So what gives you the confidence that this can be achieved through the cycle, and how do you vision your AUM mix to look like? I think you have also mentioned in your vision statement that you plan to enter affordable and gold loan segment. So any color around that would be helpful. So just if you can explain your vision here, please. Thank you.
See, on the growth, to get to a 27-28% or even a 30% CAGR, it's not difficult because the gap in the supply in this segment of micro scale unorganized businesses is huge. It is we have not even penetrated, I would say, 2 or 3% of that market. So I think when you have a complete white space, there is going to be extended periods of growth. So that's the first thing. Second is, and clearly we have the capability to drive that in terms of our breadth of branch network across the country and the automation that helps us scale up. So I don't see any operating challenge around that, so to speak. The second is that to deliver 27-28%, and from a strategy perspective, we don't have to rely excessively on the mortgage product or the micro LAP product. So therefore, we have said that as the customer demand is primarily for hypothecation loans, we will like to see 60-70% hypothecation, 30% macro LAP, and at best 10% can be some other product. And this is over the next 3 years, I would say. Gold loan and similar products which appeal to our segment of customers is what we will look at. We are in the process of doing a market survey. We are realizing that when we give out loans to 44,000 customers in a quarter, we also decline close to 55,000 customers. These customers in the end go and seek a gold loan, a substantial part, 20% plus do that. So we have the ability to source, and we are not fully leveraging that ability to source customers. So I think strategically we are going to stay with the hypothecation loan and the mortgage product for this customer segment. And gold loan or any other secured product, it could be a solar loan also, would probably be only 10% in the next 3 years.
Got it, sir. Very helpful. That's it from my side.
Thank you. Next question comes from the line of Ananga Rana with A91 Partners. Please go ahead.
Hi. So on PAR X, I wanted to understand, in order to hit our credit cost guidance, would we want to see a further decrease in PAR X, or is the 7% level sufficient to hit our 3.5-4% type credit cost for the full year?
Sure. I think, it's an excellent question. And I would also link it to the question that was asked initially about credit cost of 3.5 to 4%. See, if in our model, each product category has a different credit cost model, and therefore it's incorrect to compare one segment against the other. For example, you would not compare a housing loan against micro LAP. Similarly, you can't compare micro LAP against this product. But at a credit cost of 3.5 to 4, we will deliver a targeted ROA of 4.5 to 5% post-tax. Similarly, on this question, if our PAR X remains at 7%, we will ultimately hit a credit cost of 3.5% to 4%. In fact, if it remains at 7%, it's likely that we'll hit a credit cost of 3.5%. So we are all set to manage this XD PAR because that is the nature of the flow in the collection bucket. The answer to your question is that yes, 7% is good enough. It will deliver to us the credit cost that we're talking of 3.5 to 4%, and it will deliver the ROA which we are targeting, which is probably 4.5 to 5%.
Thanks, very clear.
Thank you. Next question comes from the line of Umang Shah with Kotak Mutual Funds. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a very good set of numbers, sir. I have a couple of questions. The first one is on the credit cost, right? And I just want to understand the broader thought process on creation and utilization of overlays, and also not just your FY27, but your credit cost guidance in your vision document, which is a more medium-term sort of a credit cost guidance. Does that include creation of overlays, utilization of overlays? I mean, how should we look at this whole math? If you could just help that would be great. Also, in conjunction, if you could just give me one data point, what percentage of our book is covered under any of the government guarantee schemes?
Hi, Umang. So with respect to the overlays, we want to create about 0.5% of the book as overlay, and primarily this is to ensure that we deliver a certain level of cross-cycle credit cost, which should be in the range of about 3.5% to 4%. That is the view with which we are creating overlays, and we believe that this will be a good year after coming out of the cycle that the entire industry saw. With respect to utilization of overlays that get created within the year, overlays are created from two intentions. One is the point that I maintained earlier, which is ideally to deliver a certain cross-cycle credit cost. The second is to ensure that any rate changes during the course of the year can also be taken into account from the overlay, adversely impacting the overall profitability level. With respect to the guidance range that we gave for this financial year of 3.5% to 4%, we do believe with the overlays we should be in that range. And that is how we are looking at the current financial year.
In terms of the ECL, we have a ECLGS scheme ongoing. It's a CFNU scheme where the book is around 4.5%.
Okay, understood. And just to clarify, the credit cost guidance that we are giving not just for 27 but also for next 2 to 3 years, that takes into account creations and utilizations of overlays depending on the cycle, right? So creation of overlays will not be outside this credit cost number.
That would be what our endeavor would be, to stay in the guidance range, and creation of overlays in good years where the credit cost is in the lower side of the range, and utilization in any kind of cycle that the industry goes through.
Perfect. That sounds good. The other point was on efficiency. Now, obviously, our OPEX ratios are slightly higher at this point of time. We are also expanding our reach materially. Now, I do see in the presentation that there are a host of efficiency measures that you guys have already enlisted. One of them being not adding new branches and obviously utilizing or sweating more of the existing infrastructure. But again, more from a 2 to 3 year perspective, given that we are a very young company growing at about 25-30% CAGR, up until what time can we sustain growth without adding branches, and at what point does it start hurting growth, assuming if we stretch this exercise a little too far?
Umang, our strategy is to increase the branch count by roughly around 10%, while optically the numbers could be higher because we have two sets of branches. One is a large branch category, the other is a mini branch, and from all sense a large branch is equivalent of 2 mini branches from a cost standpoint, from a long-term scale standpoint. So effectively what we are looking at is adding roughly around 10% odd branches or large branches every single financial year. To supplement that, we also every year see a large number of branches which enter into the 20 crore plus category, and these would be the branches opened in the first 6 years of operation, where we are actively looking at splitting those branches to tap into the micro market further, go deeper into that micro market. As part of that strategy, last year we split roughly around 44 odd branches, and the levels at which both these branches after splitting the branches they are positive or profitable from day one itself. So from a medium-term growth perspective, when we are talking about 25 to 30%, so I think a 10% addition of branches would be sufficient for that. For this year, that number change will be visible between quarter 2 to quarter 3, when the count would increase. This would be both splitting of branches as well as addition of new branches. Because a large percentage of our branches are still in the lower vintage categories, and with the average AUM of many of those 60-70% of the branches which are with average AUM of roughly around 7-8 crores, these branches can also attain the scale of 20 plus crore. So from the existing branch infrastructure, there is a long runway that is available. Many of the branches which enter into the higher AUM category will undergo split, and roughly addition of 10% of new branches every year. I think all these three put together should be delivering that growth level of 25 to 30% that we are talking of in the medium range.
Understood. That helps. And just one last question is on how should we look at our strategy in terms of direct assignment? Would it be a lot more opportunistic, or given that we are generating a lot of PSL assets, I mean, probably it would be a more uniform practice seen across the quarters?
So the way we want to approach DA is, DA normally we do for two reasons. One is to shore up the liquidity, because DA gives us immediate liquidity. The second is to put it into the P&L. Our strategy, so today as we look at the DA pool, we are at around 5%, of our AUM is DA, and therefore we are not very aggressively posturing on DA. Going forward, it will be more around as we get into relationships with banks and NBFCs, and because the relationships have to be wider beyond just term loans and NCDs, we will explore opportunities of doing DAs through the year, depending on whatever opportunities come up. We don't want to actively participate in doing a lot of DA. As a strategy, we want to limit the DA to between 5 to 7%, and that's a long-term strategy. We don't want to do more DAs.
Okay, understood. And sorry, just one last point. In terms of credit rating, post the IPO, we've already got one rating upgrade, is it?
That's right. And India ratings.
Yeah. Sorry, go ahead.
India ratings gave us No, I was saying India ratings gave us the upgrade last month.
So logically then, I'm assuming that the benefit of the same is not yet reflecting into our marginal cost of borrowing, or that's already sitting there. And how should we look at the marginal cost of borrowing going forward?
Yeah. So the incremental cost of borrowing last quarter was 10.2. The ratings came in towards the fag end of the borrowing cycle, and therefore these have not been yet factored into. We expect with this rating upgrade to get additional benefits of between 10 to 15 bits going forward.
Okay. All right. Perfect. Thank you so much. That helps, and wish you all the best. Thank you.
Thank you.
Thank you. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Varun Vijaria with Omkara Capital. Please go ahead.
Hi, sir. Thank you for taking my question. So I just wanted to understand, this is a trend that we've seen across other NBFCs also, that disbursement rate has been down about 25% plus, in our case 38% quarter on quarter. So, what is this industry like? What is this industry-wide phenomenon? Is it a seasonal thing? If you can just shed some light on that, and why has it been so way?
Hi, Varun. So there's definitely certain level of seasonality in the disbursal trends that we observe over the last, I think, the entire years of operations that we have been present. So typically we see roughly around 40% disbursements coming in the first half, and in quarter one, typically about 20 to 22% at max disbursements do come in. 40% split of disbursement in H1, about 60% split in H2. March is, or quarter four, and more particularly March is a high productive month and high productive quarter, so the disbursements definitely pick up. So sequential comparison of disbursement of quarter one to quarter four would not be the right way to look at it. The fall that we saw in this quarter is very much in line with past year trends. But I think the encouraging fact is that after a slow quarter one in the last financial year, the disbursement for this quarter and the growth of roughly 22% is highly encouraging for us and helps us more confidently move towards a guidance range of growth that we talked about. And the other good factor that played out in quarter one is the productivity levels of the hypothecation loan. Hypothecation loan is the driving engine for the business model, and hypothecation loan productivity has significantly improved. The productivity levels that we saw in quarter one are very much in line with productivity levels of quarter two and quarter three of last financial year. So those are encouraging signs and definitely will help in other parameters like OPEX also as we move along the current financial year.
Okay. And as considering that we'll be adding more branches, how is the team ramping up? Because lately we've also heard some commentary that a lot of NBFCs are also finding it slightly challenging to find people who might work on ground.
See, I think on staffing, we have never faced a challenge around getting the required staff. Because one is that we don't rely only on the NBFC industry experienced people for hiring. We can hire fresh staff also. We have trainees that we hire. We can even hire from the MFI market because we have a very strong training program to train them into how a business customer's income needs to be assessed, what data points are needed, what sort of diligence is needed on the ground. So we don't foresee any challenge around that. In fact, our plans for growth of the team are very modest. We only want to grow our team by about 10% further. And there we don't see a challenge around getting the team. This 10% growth in team will deliver the AUM growth of around 25 to 30% for us.
Okay. Thank you for taking my question.
Mr. Gajaria, are you done with the question?
Yeah.
Thank you. Next question comes from the line of Pawan Kumar with Edelweiss Public Alternates. Please go ahead.
So thank you for the opportunity. Just one question from my end. Many of your borrowers would also be having gold loans and the digital fintech loans because they would be using the QR codes, right, in their business, day-to-day business. And I'm sure you track that number, how much of the current percentage of the borrowers have these loans. Can you please highlight what percentage of your borrowers have, number one, gold loans, number two, digital fintech loans, and how it has moved over the quarters? Yeah, that's it from my end. Thank you.
Yeah, so out of the total borrower base, I think somewhere in the range of about 10 to 12% of the people have gold loans that we have observed, and from that perspective, we do feel that as a product line which is a huge opportunity for us in the long run. Now from a digital fintech loans, now it is very difficult to really categorize when we do bureau scrub. It is difficult to really categorize loans into the digital fintech loans. We do see small ticket size loans. Now these could be personal loans from fintech players, could be also consumer durable loans and others. So it is a bit difficult to really comment on the percentage of borrowers who would be using fintech apps. Having said that, because you touched upon the fact of QR codes and it can be a channel through which many fintech players offer loan. However, we do feel that one, the penetration of QR code in the markets that we are talking of, which is tier 2, tier 3 markets, and when you talk of from the city center to almost 20-25 kilometers outside the city center, that penetration is not to the tune that we read in headline numbers for many of these initiatives, digital initiatives. Also the fact the usage of QR code for trading or payments from their overall volume of business is still minimal. If I have not be wrong, I think a good guess would be between about 15% to 20% at max would be what is the volume that goes through QR code for many of the players who would be using QR codes. And we do feel that is not enough of data point to really offer a business loan. So we don't see digital payment, digital fintech players as a strong competition for us for the product offering that we have in this space.
Thank you, sir. No other question from my end.
Thank you. Next question comes from the line of Nischint Chawathe with Kotak. Please go ahead.
Yeah, hi. So just before, just a clarification. You mentioned that 10% of your customers have gold loans. So over here, you consider customers of LAP and property, or do you also consider hypothecation loans?
So it is the total portfolio base that I'm talking of when I refer to the 10% number.
Nischint, if you are asking that what percentage of our customers have mortgage loans from other players, that would be almost negligible. It would be less than 1%. But they do have gold loans, and we do factor in the gold loan into our FOIR calculations, etc.
And in the last 1 year, would you have probably seen any difference in the collection behavior or customer performance for those with gold loans or without gold loans? I mean, any such study that you probably have done to kind of read whether gold loan has helped collections at all?
Nischint, we don't have that data upfront whether the gold loan customers have performed better, but my guess would be that there might not be that much of a correlation. Because think of it that way, that a customer who after taking a business loan also takes a gold loan is probably leveraging himself. But then you also look at someone who has taken a loan and has gold, has better net worth, and gold loan has a bullet repayment, so it can lead to a imbalance in repayments from a customer's perspective. But we don't have the data for that. Maybe later on we can probably share some data on that.
Yeah, that would be helpful. And just one, do you have a strategy around co-lending? I mean, I know we discussed in detail about DA, but
yeah. See, I think our approach on co-lending and DA are based on the premise that one, we don't have any challenge around raising funds in the market for our lending. So we have a very diversified set of borrowers from whom we borrow, which includes a lot of mainline banks, private banks, small finance banks, NBFCs, and DFI. So we don't have a need to get into those constructs just for liquidity. The second is that we don't need them either for improving our profitability metrics. I think given that, we find that because our ticket size is very small, so therefore doing all the hard work of originating it and then finding that I can only keep 20% of the 1 lakh rupee loan does not work in my favor, because it doesn't defray my cost. So it's only because of that dynamic that co-lending does not appeal to us, because if we were lending at probably a 10 lakh rupee ticket size, then even keeping a 1 lakh rupee on our books or 2 lakh rupees on our books does give you the income stream that that can defray the processing fee. But processing fees are very small, despite the fact that the loan is as small as 1.5 lakhs. Our processing fee is still 2.5%. You can think about that it's only 2,500 rupees. Many of the mortgage players would take more than that only for the legal technical fees. So I think the dynamic does not work for us. Also, having said that, we don't see any problem with that because we know the quality of our portfolio is good. We don't have to worry about volatility of credit costs. In fact, the reason that you'll find that CGMFU have only done 4.5% of our book on CGMFU because we don't see a huge benefit coming because our credit costs are low and well managed.
Got it. That's helpful. Thank you very much and all the best.
Thank you. Next question comes from the line of Gokul with BTH Capital. Please go ahead.
Hi, am I audible?
Yes, Gokul, you are.
Yeah. So just want to understand, currently our leverage levels are at 3.15. So is there a target we have in mind that where you want to settle at?
The leverage. Yeah, so the leverage right now is at 3.15. In our longer term strategy, we expect that once it approaches the 4 to 4.5 levels, that's when we'll need to look at fresh capital. But till then, we don't need. And basis internal calculations that we've done, that would mean that we have enough capital for the next 2.5 years of growth.
Got it. And what is the LTV for each type of loan that we have currently?
LTV for the micro LAP loans, typically we see a LTV of about 35 to 40. For the hypothecation loan, we should see somewhere around, I think we should see around 60% on the inventory levels that we observe.
Okay. And one more thing, so I see the foreclosure rate has been mentioned at some 5%. So what is the what is our experience in terms of realization that we get from these foreclosures, and how liquid are these assets?
So this is the pre-closure.
You are talking of settlement. I think maybe we'll answer on the settlement.
Settlement, or you are saying like BT out sort of cases?
No, yeah, this 5% that you are referring to that is mentioned in the PPT is the pre-closure rates that we see on our portfolio. Now, on the pre-closure rates, again, the two products, I think hypothecation loan has very low pre-closure rates. Typically, we see annualized pre-closure rates of roughly around 3 to 3.5 odd percentage. Mortgage, because of the nature of the business and BT outs and BT ins that happen over the industry, that is relatively on the higher side. At a blended level, we see some around 5% to 5.5% that is mentioned in the PPT.
And however, due to that, we are getting foreclosure charges from the BT out cases, so that is in line with the industry actually.
Got it. Thank you.